There's one bill that follows you no matter what you do. It doesn't care if you get a raise, it doesn't care if the market crashes, and it definitely doesn't care how hard you work. And that bill is rent. It shows up every month, higher than last year. Josh deals with the same thing. His rent shows up every month too, and it keeps getting more expensive, whether his income changes or not. So he asks a simple question. What if this bill didn't have to come from his paycheck? What if it could be covered by dividends from investments instead? And this isn't about starting with a huge amount of money. Josh isn't investing $100,000 or $1 million. He's starting with just $10 a day. In this video, I'll show you what it actually looks like when Josh invests $10 a day and lets dividend income grow over time. You'll see how long it takes, what slows things down, and which monthly dividend stocks can realistically get rent paid with income. And at the end, I'll show you how Josh, starting with just $10 per day, reaches the point where rent is covered by income alone in as little as 13 years. But before any of that makes sense, we have to look at rent itself. Because if rent feels expensive today, it's usually because you're looking at it in isolation. One lease, 1 year, one renewal notice. But rent only really makes sense when you zoom out and look at what rent has done over time. In the 1940s, the average monthly rent in the US was about $27. By the 1970s, it crossed $100. In the 1990s, it moved into the $400 range. Around 2010, average rent pushed past $850 per month. After 2020, rent accelerated. By 2022, median rents were above $1,300. In 2023, they moved closer to $1,400. And by 2024 into 2025, the long-term trend points toward roughly $1,500 to $1,600 per month. This isn't random growth. Rent doesn't move in straight lines, but over decades it compounds. Small increases stack on top of each other, and once rent resets higher, it almost never goes backward in a meaningful way. That's what Josh is dealing with right now. His rent isn't jumping every month, it's just staying high, and that alone is enough to keep pressure on everything else. So instead of debating whether rent is too high, it makes more sense to set a clear target. For this video, the target is simple: $2,000 per month. That's the bill we're working toward replacing with income. With that target in place, the problem becomes a math problem. If rent compounds upward over time, income has to compound alongside it. And that leads directly to the next question. What does it actually take in real numbers to build $2,000 per month in dividend income that shows up consistently? Let's start with the simplest version of the problem. To collect $2,000 per month, you need $24,000 per year in income. If a portfolio pays a 3% dividend yield, generating $24,000 a year requires about $800,000 invested. At a 5% yield, the required investment drops to about $480,000. At 7%, it's roughly $343,000. At 10%, the number falls to about $240,000. Those are the lump sum numbers. That's what it would take if someone showed up today with a check and wanted rent paid immediately through dividends. Josh doesn't have that kind of capital. Most people don't. And that's exactly why this doesn't stop here. Josh is starting with $10 per day. The goal isn't to show up with $240,000 or $800,000 on day one. The goal is to move toward those numbers while income builds alongside the portfolio. So the real question becomes speed. If Josh invests $10 per day, reinvests every dollar of income, and focuses on assets that actually produce cash consistently, how fast does that gap close? How long does it take before the income starts doing part of the work? And at what point does his investment pay him $2,000 per month? In a couple of minutes, I'm going to walk you through a list of monthly dividend stocks on Josh's list, showing how each one can reach that income level and how long it takes to get there. And in the end, I'll show you one monthly dividend stock that helps Josh reach this goal in as little as 14 years. But before we get there, you need to know the checklist on which these monthly dividend stocks are selected in the first place. You need a few rules in place. If you skip this part, it's easy to get pulled toward things that look good on the surface but don't actually help you pay rent. Start with how often income shows up. Your rent is due every month, so the income needs to show up on a similar schedule. When cash comes in regularly, reinvesting stays simple, and the system keeps moving without gaps. Next, think about whether the income survives rough periods. You want stocks that keep paying through different market conditions. If income disappears during stress, everything slows down. Consistency over time is what keeps compounding alive. Then look at where the income comes from. Some payouts are backed by real cash flow that keeps coming in. Others depend on leverage or short-term support. Every pick on this list has a clear income engine that holds up under scrutiny. Then comes growth, but controlled growth. Income gets things started. Growth helps the income get bigger over time. The goal is balance, where income starts the portfolio and growth keeps it accelerating. Every stock you're about to see fits into this structure. Some help keep income stable, some push income higher sooner. Others help shorten the timeline by adding growth. Each one plays a different role, and together they show different ways the timeline toward $2,000 per month can look. So let's get into it. At number 5 is Realty Income, ticker O. Realty Income is a net lease real estate investment trust. Its purpose is narrow and deliberate. Own income-producing properties, secure long lease terms, and distribute predictable cash flow to shareholders. It is not designed to outperform the market or grow aggressively. Its role is structural: provide income stability inside a rent-focused portfolio. The business model is built around visibility. Properties are leased under long-term contracts where tenants pay taxes, insurance, and maintenance. Once leases are in place, operating costs stay low and cash flow becomes highly predictable. This structure shows up clearly in profitability. Gross margins sit above 92%, while operating margins remain strong at roughly 45%, which is unusually high for a real estate business. These margins explain why income remains steady even during economic slowdowns. Price appreciation has never been the primary driver for Realty Income. Over the past 10 years, the stock has delivered roughly 10% total price appreciation, translating to just over 1% annualized price growth. The shares currently trade around $57, and forward expectations remain conservative. Analysts place the average one-year price target near $61.92, with downside estimates around $54 and upside projections near $68. That narrow range reinforces the reality of the business model. Realty Income is not designed to compound through price expansion. Its role is income stability, with returns driven primarily by dividends rather than share price growth. The balance sheet reflects a mature REIT structure. Total debt sits near $29 billion against a market capitalization of roughly $53 billion, resulting in an enterprise value of around $81 billion. This level of leverage is intentional and typical for large net lease operators. The important factor is not the size of the debt, but the company's long history of servicing it without interrupting dividends. Institutions see it the same way. About 79% of the shares are held by long-term investors who care about dependable income, not short-term price swings. That brings us to the reason this stock earns its spot here: income. Realty Income pays a monthly dividend, currently yielding about 5.65%, with dividend growth averaging 3.86% per year over the past decade. Price growth stays modest, income does the heavy lifting. Now, let's say Josh invests $10 per day into this monthly dividend stock. By the end of year 1, he's invested about $3,650. The dividend income is still small, but this is the part that matters most. The base is built, shares are owned, the system is in motion. By year 10, the portfolio is projected to be valued at approximately $53,000, with annual dividend income reaching about $3,000. At that point, dividends begin to support overall growth rather than simply sitting in the background. By year 20, the portfolio is projected to grow to roughly $188,000, while annual dividend income rises to around $15,000, reducing reliance on new capital. By year 23, projections show the portfolio valued near $269,000, with dividend income growing to approximately $24,000 per year, or about $2,000 per month. That's the point where rent is covered by income alone, so with Realty Income, it would take Josh about 23 years to get there. That works, it's realistic, but it's slow. So the next question is obvious. What happens if the income shows up faster? That brings us to number 4, Capital Southwest with the ticker CSWC. This one works very differently from Realty Income. Instead of owning physical properties, CSWC lends money to lower middle market companies. Most of that capital goes out as secured loans, with some equity exposure layered in. The goal here is simple: generate higher recurring income while still participating when those businesses grow or exit. CSWC runs a focused portfolio. It invests in a smaller number of companies, which allows tighter underwriting and closer oversight. That concentration increases responsibility, but it also improves capital efficiency. Over the past 10 years, this approach has worked. The stock delivered a total return of roughly 62%, even while prioritizing income over aggressive price appreciation. Profitability metrics highlight why CSWC sustains its payout. Gross profit margin sits at 100%, which reflects the nature of interest-based income. EBIT margin is approximately 86%, and net income margin stands near 39.8%. These numbers indicate that most revenue flows directly to the bottom line. Return on equity is about 9.95%, and return on assets is 4.28%. Strong figures for an income-focused structure operating without excessive leverage. Capital structure is controlled. The company has a market capitalization of about $1.28 billion and total debt of roughly $1.04 billion, supported by $87 million in cash. Enterprise value comes in around $2.23 billion. That structure allows CSWC to keep funding new deals without stretching itself too far, even in higher rate environments. Ownership is spread out. Institutions hold about 28.9%, insiders around 3%, and public shareholders roughly 68%. That keeps control balanced while maintaining management alignment. Valuation remains reasonable for the income produced. The stock trades around 9.6 times forward earnings, which reflects investor caution around credit cycles rather than structural weakness. Analysts currently rate the stock a buy, with an average price target of $23.50, implying moderate upside from current levels. The high target sits at $25, while the low case is $21.50, framing expectations within a controlled range rather than speculative extremes. Risk is present, but it is transparent. CSWC is exposed to credit quality, economic slowdowns, and interest rate shifts. However, its focus on secured lending, disciplined leverage, and active portfolio management reduces the probability of permanent capital impairment compared to more aggressive yield vehicles. Where CSWC really separates itself is income. The stock currently yields about 11.49%, materially higher than REITs like Realty Income. Dividend growth has averaged 3.18% annually over the past decade, and share price appreciation has averaged about 4.5% per year. That combination allows reinvested income to compound on a growing base. Now look at what that does to Josh's timeline. If Josh contributes $10 per day, by the end of year 1, he would have invested about $3,650. By year 5, the portfolio would be valued at roughly $25,000, with annual dividend income around $2,000. Income starts to show up in a meaningful way. By year 10, the portfolio would grow to approximately $75,000, with dividend income rising to about $6,000 per year. From here, compounding becomes much more noticeable. By year 19, the portfolio would surpass $300,000, with annual dividend income reaching roughly $24,000, or about $2,000 per month. The timeline is shorter than that of Realty Income because the starting yield is higher. Each invested dollar produces more cash earlier, and that cash gets reinvested faster. That's the trade-off. Higher income upfront accelerates the timeline. Now let's push it even further. Third on the list, Stellus Capital Investment Corporation with the ticker SCM. This is a business development company focused on lending to lower middle market U.S. companies. Its role in this list is straightforward: generate high, recurring cash flow from private credit rather than public equity growth. SCM is not designed to deliver rapid capital appreciation. It is designed to convert capital into income. Most of SCM's portfolio sits in first lien and second lien loans to privately held businesses. These loans are usually floating rate, which means the income adjusts as interest rates change. At today's price of around $13 per share, the stock reflects that income-first design. Over the last 10 years, the share price itself hasn't moved much, with a total price return of roughly 35%. That's expected. SCM is built to pay, not to add value using the stock price. The income can be seen in the margins. Gross profit margin sits at 100%, EBIT margin around 70%, and net income margin near 29.8%. Operating costs stay low relative to interest income. Returns remain steady rather than flashy, with return on equity around 8.2% and return on assets near 3%. The focus stays on conservative lending, not aggressive leverage. That same approach shows up on the balance sheet. SCM has a market cap of around $371 million, total debt of nearly $632 million, and an enterprise value of just under $1 billion. Cash on hand sits around $9 million, which is normal for a BDC that keeps capital deployed rather than sitting idle. This structure prioritizes earning assets but leaves less margin for operational error, making credit quality critical. Ownership data confirms SCM's retail-oriented profile. About 83.72% of shares are held by public investors, while institutions hold only 12.37%, and insiders hold about 3.91%. This ownership mix contributes to higher yield demand and less price stability compared to institution-heavy REITs or ETFs. Analyst expectations line up with that reality. SCM carries a hold rating with a $13 price target. The thesis here isn't valuation expansion, it's income. From an income perspective, SCM is aggressive. The stock currently yields about 12.48%, compensating investors for credit risk and limited price growth. Dividend growth has averaged about 1.64% annually over the past decade. Share price appreciation has averaged roughly 2.64% per year. Cash flow does the heavy lifting. Now look at what that does to Josh's timeline. If Josh contributes $10 per day, by the end of year 1, he would have invested about $3,650. By year 5, the portfolio would grow to around $24,000, with annual dividends reaching roughly $2,000. Income begins to show up early. By year 10, the balance would reach approximately $72,000, and annual dividend income would rise to about $7,000, becoming a meaningful part of growth. By year 18, the portfolio would grow to roughly $246,000, with dividend income reaching about $24,000 per year or $2,000 per month. This timeline overtakes the earlier picks because more cash goes to work immediately. The higher starting yield produces income faster, and that income gets reinvested sooner. Even with modest price growth, compounding accelerates because cash flow shows up early and often. Sounds good, but there are even better options. And in the end, I'll show you and Josh a monthly dividend stock that can help you reach this goal in as little as 13 years. Now let's take it one step further. Number 2 on the list is the First Trust Buy Right Income ETF with the ticker FTHI. Its role is income generation with controlled equity exposure. Unlike pure equity funds, FTHI combines ownership of large-cap U.S. stocks with a systematic covered call strategy. The objective is not maximum upside. The objective is steady cash flow with moderated volatility. FTHI holds 188 stocks, mostly large-cap U.S. companies. Technology leads the portfolio at about 33.6%, followed by financials at 16.2%, consumer cyclicals at 10.3%, healthcare at 8.9%, communication services at 8.4%, and industrials at 8.1%. These are the same companies driving the broader market. The difference is how returns are generated. Instead of relying mainly on price appreciation, FTHI reshapes returns through option premiums. At the holding level, concentration stays controlled. The top 10 positions make up about 37.6% of the fund. Nvidia, Microsoft, and Apple lead the list, followed by companies like Amazon, Visa, Broadcom, Alphabet, MasterCard, and ASML. Strong businesses without leaning too heavily on any single name. Over the past 10 years, FTHI delivered a 27.1% total price return, which understates its full contribution because income is the primary output. The fund distributes income monthly with a trailing 12-month dividend rate of $2.06 per share. This rate comes largely from option premiums layered on top of underlying dividends, not from leverage. On the other hand, costs are the trade-off. FTHI carries a 0.76% expense ratio, higher than index funds but typical for an options-based strategy. The fee is effectively the price paid for outsourced option execution, income smoothing, and operational complexity that would be difficult to replicate manually. Risk stays controlled. Annualized volatility sits around 15.3%, slightly lower than the broader equity ETF average. Portfolio turnover is just 7%, which points to a disciplined rules-based approach rather than frequent trading. From an income perspective, FTHI offers a balanced profile. FTHI delivers an 8.65% yield with 7.47% annual dividend growth over the past decade. With 1.85% average annual price appreciation, returns are driven mainly by income rather than price growth. Now look at what that does to Josh's timeline. If Josh invests $10 per day, by the end of year 1, he would have invested about $3,650. By year 5, the portfolio would grow to roughly $23,000, and annual income would reach about $2,000. Income starts to matter earlier. By year 10, the balance would reach approximately $71,000, with dividend income climbing to around $8,000 per year. At this point, income becomes a meaningful driver instead of a side effect. By year 14, the portfolio would reach about $156,000, with annual income rising to roughly $24,000 or $2,000 per month. What's interesting here is how this happens. FTHI doesn't start with the highest yield on the list. In fact, its starting yield is lower than the BDCs we just looked at, but it still gets there faster. The reason is dividend growth. FTHI's income has grown at about 7.47% per year, which is higher than any of the stocks we've covered so far. That growth compounds on itself. Each year, more income gets reinvested and the base gets bigger. That's why this fund moves ahead of higher yield options over time, not because it pays more upfront, but because its income keeps accelerating. And that brings us to the last one. Taking the number 1 spot is BlackRock Science and Technology Trust, ticker BST. This one plays a different role than everything else on the list. Here, growth does most of the work. BST is built to own innovative technology in science-driven companies, then convert part of that growth into a steady monthly income. It is not trying to be conservative, it is trying to compound faster. BST holds 187 positions, but the exposure is intentional. About 75.5% of the portfolio sits in technology, with another 16.3% in communication services. The remaining allocation is spread lightly across consumer cyclicals, industrials, and financials. This reflects where long-term earnings growth has actually been happening. The top holdings make that clear. Nvidia alone makes up about 15.1% of the portfolio, followed by Microsoft at 8.1%, Broadcom at 7.8%, and Apple at 5.5%. The top 10 positions account for roughly 53.1% of total assets. That concentration is deliberate. BST leans into companies that dominate their industries and reinvest aggressively. Over the past 10 years, this approach has worked. BST delivered a total return of roughly 172%, even with major drawdowns along the way. That includes the sharp sell-off in 2022 when rising interest rates hit technology valuations hard. The recovery since then reflects earnings power rather than speculation. The structure is active and the cost reflects that. The expense ratio sits at 0.88%, higher than an index ETF, but reasonable for a closed-end fund that actively manages positions and generates income. Assets under management are around $1.48 billion, providing scale and liquidity. Risk needs to be understood clearly here. With more than half the portfolio in the top 10 holdings and heavy exposure to growth stocks, BST will move more than the broader market. Turnover runs around 19%. This is not passive exposure. BlackRock adjusts positions as technology leadership shifts. What balances that risk is income. BST delivers a 7.39% current yield, supported by a combination of dividends, capital gains, and option income layered on top of growth holdings. Over the past 10 years, dividend growth has compounded at 15.43% annually, which does the heavy lifting here. On top of that, share price appreciation has averaged 9.81% per year. This combination allows BST to generate meaningful income while still benefiting from long-term growth rather than relying on yield alone. Now look at what that does to Josh's timeline. If Josh invests $10 per day, by the end of the year, he would have invested about $3,650 with income still minimal. By year 5, the portfolio would grow to roughly $26,000, with annual income reaching about $2,000. Income starts showing up early. By year 10, the balance would reach approximately $95,000, with dividend income rising to around $9,000 per year. At this point, income becomes a meaningful driver of growth. By year 13, the portfolio would grow to roughly $192,000, with annual dividend income reaching about $24,000 or $2,000 per month. That's rent covered through income in just 13 years, almost 2 times faster than the realty income. This is why BST earns the top spot. It doesn't start with the highest yield on the list. What sets it apart is growth. Dividend growth here is higher than anything on the list, and that growth compounds on top of strong price appreciation. Now let's lay everything out on one simple timeline. This makes it easier to see how each approach actually plays out over time, using the same $10 per day contribution and the same $2,000 per month rent target. On the far end of the timeline is realty income. It reaches the goal around year 23. The income is steady and predictable, but the trade-off is time. This is what slow, conservative compounding looks like. Next is Capital Southwest. With a higher starting yield, it reaches the target sooner, around year 19. More income shows up earlier, which helps the timeline move faster. After that comes Stellus Capital. Its higher yield pushes the timeline forward again, hitting the milestone around year 18. More cash flow upfront means compounding has more to work with. Then there's FTHI. Even though it doesn't start with the highest yield, faster dividend growth moves it ahead of the BDCs. It reaches the target around year 14. And finally, BST reaches the finish line the fastest, around year 13. Growth does more of the heavy lifting here, and dividend growth accelerates the income base faster than any other option on the list. Want to know how a simple $10 a day investment can grow into a portfolio that pays more than $9,000 a month in dividend income? Click the video on screen to find out.